So talking about the pandemic, what are your thoughts about the pandemic? Now, in my view, what you all are doing is correct, right? This is the ideal time to acquire new skills, to upskill yourself, right? To gain new knowledge, so that you are better equipped to come out when the country opens up, when the world opens up. There is the port city coming up. So we might see a lot of new jobs being created within the next 3 or 4 years, hopefully. Lots of foreign investments coming in, FDIs coming in, right? So there is a lot of hope, right? All we have to do is just to get the vaccination drive going, settle things down, and open up the country, right? So we are ready to go as a nation. Also, the economy, well, took a beating because of COVID, and we are now recovering. You would have seen the earnings of the quarterly results of most of the companies that have been recently released. Fantastic results. And especially the companies which have dollar earnings have done really well. Right. I'm not going to name any companies, but if you're also following the stock market, it would have been an amazing bull run, right? And the bull run is expected to continue. Now, this is in spite of interest rates being hiked by the central bank a couple of days ago. You would have noticed, hopefully, right, being banking students, all of you are supposed to be aware of this. There was an interest rate hike by what percentage? Interest rates went up by what percentage 2 days ago?
0.5 basis.
Very good. 0.5 basis points. What else happened? Not only a rate hike, SPF and SLF was increased.
SRR also increased.
Also increased by
2%.
2%. Excellent. So what is the impact of that? The impact of interest rates going up and SRR being increased?
There is a possibility to release some pressure on the exchange rates.
Very good. Yeah. Good. What it does is it might to some extent reduce consumption-related spending, right? People, because interest rates are going up and there is less liquidity in the market. Also, central bank is having an eye on the imports, right? There are input restrictions in place, and so there is a good control on the foreign exchange reserves that we have. Now that's also very important because it's these reserves which we have to manage carefully, right? Because these are external foreign currency denominated reserves we will have in currencies, maybe in gold and all that. So these reserves, once they deplete, it's not easy to get them replenished, right? Very difficult. Right? So it's very important that we manage the reserves very carefully. We can't afford to waste a cent these days. We have to manage it very, very carefully. So which is why it's a good move to have increased interest rates. Right. Okay. Now, which makes this topic very, very important. Also, trade is very important nowadays with the import restrictions coming in. Yeah. Right. So talking about the pandemic, this is the ideal time for you all to upskill yourself, learn something new, and hit the ground running, right, when the country and the Colombo port city opens up. So there is lots of opportunities. Lots of opportunities will be created. And when they do come, you should be ready to grab them with both hands, right? So many new multinational companies will come and establish themselves in the port city. So just have your eyes and ears open and be ready, right? The opportunities will present themselves, which is very, very good for the entire economy. Now, for one thing is per capita incomes will go up. Foreign reserves will start coming in. We might be able to relax some of the import restrictions that are in place. And so the quality of life is expected to improve. Yeah. Because we are almost past the worst, right? So things will only get improved from this point. Yeah. Any questions up to now? Well, we just started. You might not have any questions so far. Okay. Now, most of you are coming from a trade background, I suppose, and coming from a trade background, I think, yes, most of you would have dealt with foreign exchange. Is there anyone who has no clue about foreign exchange? Because I need to know where I should pitch this. Should I pitch it at ground zero or should I pitch it at 33,000 feet? Foreign exchange, no experience whatsoever. Right? It's okay because this is where we learn. As much as you learn from me, I also hope to learn from you all. Right? So just be willing and ready to share your experience. Now, are all of you thorough with foreign exchange? Can I assume that everyone has a very good understanding and idea about foreign exchange?
It's not a full extent, no.
Okay, but you know the basics. So can we skip the basics?
I suppose yes.
Okay, excellent. Right. Well, I'm normally used to writing on boards and all that, but today handicapped with the travel restrictions in place, right, I have to conduct a class from home. So there is we don't have the luxury of a board. So what I'll try and use the Excel sheet to the best. I'm not sure whether it should be a problem. I think hopefully it should work. Right. Any one of you who wants me to touch base on the basics also?
Yes, please.
Okay, you want the basics also. Anyone else? Just one person?
Yes, we need the basics also.
Okay, all right, okay, yeah. Which is also good, right? Because if you have the basics in place, then it's a matter of building on the basics, no? Right? Now, for you all to make a house, you need a proper foundation, no? Without the foundation, you can't go up. So it's good to have the basics also in place. And some of you who already know the basics might get bored, you might fall asleep, but try to keep up, right? And let's see what we can do. So we'll start with baby steps and then move forward. Now, I don't agree that, one thing I don't agree is that you all don't have the basics. I tend to disagree because, well, what is foreign exchange? What do you mean by foreign exchange? Hello? Are we back online?
Yes, sir.
Yes, now is okay.
All right, okay. Yeah, this is part of the reason why I don't like conducting classes from home. I have a mobile hotspot. Whenever calls come, it gets disconnected, right? So we'll have to live with that for today. Very unfortunate, but such are the circumstances. Yeah. Now, why does different countries have their own currency? Why can't the entire world have just one currency? Why does the US use US dollars? Sri Lanka has Sri Lankan rupees. India has Indian rupees, all with different values. Then Saudi has Saudi Riyal. Why? Why not just one currency for the entire world? Like, for example, Euro, right? About 19 odd countries are using the same currency. So why can't the entire world adopt that model and use just one single currency? What do you think? If that was the case, then we could have straight away skipped this chapter. Right? You don't have to learn anything on foreign exchange. No need. Yeah.
I would say a currency represents a lot of things, like a country's unique sovereignty, It's
Very good.
cultural as well
Yeah.
as heritage.
Yeah, exactly. Good, good. Also, I have some noisy neighbors, so we'll have to keep up with that also. Yeah, what you said is quite right. Now, it represents the sovereignty of a nation. Now, so would let's say a country like US, do you think US will be willing to use the Chinese yuan as their currency? If the Chinese yuan was the only currency in the world, they will not. Will China be willing to use US dollars? No. Yeah, so it's sovereignty. Very good. What else? So political reasons as well as sovereignty of a nation.
The production capacity and the gold reserves of that particular nation.
Yeah. Okay. What you mean is now it can affect the money supply of a country, right? If the entire world uses one single currency, they will lose the ability to well, what they lose is monetary policy independence. That will be lost. They will lose monetary policy independence. That means 2 days ago, our central bank hiked interest rates by 0.5%. Right? That's because they thought there is a need to hike interest rates, and the economy is going in such a direction that a rate hike is warranted, right? But if that was not the case, it would have been tough. I mean, if the entire world was using one single currency, an interest rate hike would have been impossible, not possible at all. Why? Well, see, now classic example I can give is Greece, right? Greece defaulted on their bonds. Why did that happen? Because Greek bonds were issued in euro, right? And the currency that is used in Greece is the euro. So how come Greece defaulted on their own currency? Now, but because the general principle is that no country will default on their own currency, right? So if you buy Sri Lankan rupee bonds, the government will never default on Sri Lankan rupee bonds. So if you buy US dollar bonds, the US government, right, the Federal Reserve will never default on dollar denominated bonds. Likewise. But in this case, Greece defaulted on their own currency. Why?
Was it due to inflation?
Yeah, inflation. Then to control inflation, one thing is to use monetary policy. No, Greece did not have the independence to exercise monetary policy independence. Why?
So euro is using for another few 90s
Well,
countries.
Exactly. Yeah, you hit the nail on the head. Because euro is used in Greece, it is also the common currency for the entire union, the eurozone, right? The 19 odd current countries are using the same currency. Now, if Greece ran short of euros, they can't print euros, right? Because see, in the case of Sri Lanka, right? If the Sri Lankan government ran short of rupees, we can print rupees. If the US government runs short of dollars, they can print dollars. Right? That is a tool which is vested with the authority of the treasury of any country. But if Greece ran short of euros, they can't print euros. Why? Because euros, the central bank is not the Greek central bank. It's the European Central Bank, the ECB, controls the supply of money in the eurozone. Okay, so Greece on their own could not print euros, so that they defaulted. Yeah, so that is one of the main reasons. Any country will lose monetary policy independence if sorry, I pressed the wrong button. Okay. Yeah, will lose their monetary policy independence if they use a common currency, right? Which is not a very popular decision to make, right? The other thing is, I don't really agree that all of you or any of you have no basic background of foreign exchange. That I strongly refuse to accept. Why? Any idea? Now, how many of you have never bought a loaf of bread? How many of you have never bought a pen, a pen, or a book? Anyone? No? Now, for example, if you buy this pencil, right? If you know how to buy this pencil, you're a master of foreign exchange. Simple as that. Right? Understood? Because there is absolutely no difference between buying a pencil and buying dollars. Why do I say that? Why do I say that? No difference between buying a pencil and buying dollars.
Because money is a commodity.
Yeah, you can consider money as a commodity, right? Because let's assume this pencil is 100 rupees. Yeah. So if I want to buy this pencil, it will say one pencil is 100 rupees. So likewise, $1 is 200 rupees. What is the difference? There's absolutely no difference. So if you know how to buy a pencil or a loaf of bread or whatever, then you know foreign exchange. You're a master of foreign exchange. There is nothing new for you to learn. Therefore, we will stop studying about foreign exchange. Yeah. So that's the end of today's chapter. Thank you very much. All the best. See you all next week. No, I'm just joking. By the way, we spoke about monetary policy independence now. That means the central bank can decide whether to print money or not, right? Can you give me an example where monetary policy independence led to, well, an economic disaster, right? An economic disaster, a real crisis. And eventually that country had to drop their own currency. Can you tell me an example? This, I think, is a commonly hacked example. So all of you probably know it. I'm talking about which country?
Italy?
Italy?
Yeah.
The Italian lira?
Yes.
No, actually, Italy is also using euro, right? There was a small problem in Italy. They were under the threat. Well, everyone expected them to drop out of the eurozone. It never happened. Right? They managed to, in fact, Germany managed to rescue Italy, right? So Italy managed to bail themselves out. But another example.
Venezuela?
Good.
Oh,
Good. Yeah.
Zimbabwe?
Very good. Yeah, Zimbabwe. Right. It was a total disaster in Zimbabwe. Why? Because Zimbabwe has runaway inflation. Right? The inflation rate is 200% plus. It's about 500% if I'm not mistaken. Right? That means if you buy a loaf of bread today, tomorrow you have to pay double to buy the same loaf of bread. So inflation was that bad, pretty bad. Now to address inflation, what the central bank did was they increased money supply, right? So when money supply goes up, interest rates drop. Now, Zimbabweans, when interest rates dropped, they started consuming more and more. And whatever they consume, most of them, it was imported, right? So when interest rates dropped, they started consuming more, and which led to more imports, right? Then to import more, you need foreign exchange, no? Because when you import, you don't pay in Zimbabwe dollars, no? You all know better than me. You have to pay in dollars, US dollars, right? So the demand for US dollars went up. Now, when the demand goes up, what happens to the price? When demand goes up, the price also.
Prices also increases.
Yeah, prices also will go up, right? So the demand for dollars went up, and with it, the exchange rate or the price of a dollar went up. Now, when the exchange rate goes up, whatever that is denominated in dollars will also increase in price, isn't it? The price of whatever denominated in dollars will also increase, right? So the price of goods and services started going up. Now, the price of goods and services going up is called what?
Inflation.
It's called inflation. It led to inflation. Again, inflation. Inflation meaning interest rates also go up, right? So to bring down interest rates again, the Zimbabwean central bank started printing money, increased money supply, brought down interest rates, consumption went up. With consumption going up, imports also go up, right? When imports go up, demand for foreign exchange goes up, right? And the dollar goes up. Again, goods and services denominated in US dollars, the price of goods and services denominated in US dollars also go up with it, right? So again, inflation. To address it, once again, money printing, bring down interest rates, and this cycle continued. That was a good cycle or a bad cycle?
Very bad.
Very bad cycle. So it's called a vicious cycle. Right? There are two cycles. One is a virtuous cycle. The other one is a vicious cycle. Virtuous cycle is something good that happens to an economy. So if there's a cycle which leads to something good happening in the economy, it's called a virtuous cycle. The opposite is a vicious cycle, which is a cycle which leads to something bad happening to the economy. Right. So what happened in Zimbabwe is a vicious cycle. Now, talking about cycles, we'll come back to that later. Right. So Zimbabwe, right? Exchange rate kept going up. Now, what do you think was the final reading of the Zimbabwe dollar? How much was one US dollar in terms of Zimbabwe dollars?
20,000 to 1.
20,000, huh? 20,000? That's what you said, right?
Yes.
Okay. Good. Close. This is 35,000. Can you all see the screen, by the way? I'm sharing an Excel sheet. Yeah, I'm
Yeah, can
sharing.
see, sir.
Okay, okay. Right, so this is $1 was 35,000, then 35. This is 35 million. 35 billion. 35 quadrillion. Sorry, it's 35 trillion. This many Zimbabwe dollars, right? One US dollar ended up being 35 quadrillion Zimbabwe dollars, which was a disaster. Okay. So all you had to do to become a quadrillionaire was to take one US dollar and go to Zimbabwe, right? Overnight quadrillionaire. What led to this situation? Hyperinflation. So hyperinflation can ruin an economy. Now this is not sustainable. Right? Zimbabwe central bank eventually ended up printing $1 million Zimbabwe note. Right? So you divide this by a million. you will still need 35 billion $1 million notes, isn't it? Right. So to buy a loaf of bread, you'll have to take 10 truckloads of $1 million notes, right? Which is not possible. So there was no choice but to drop the Zimbabwe dollar, right? And they are currently using the US dollar as well as the South African rand as proxies to the Zimbabwe dollar. Okay. Any questions up to now?
No, sir.
No questions. Okay. No questions means two things. You either understood everything or you understood nothing, right? So let's be optimistic. Let's just assume that you understood everything. By the way, we spoke of virtuous cycles also. Now, just to explain a virtuous cycle, what do you think is best for you all to go and put your earnings in the bank and save it or to spend it? What is the best thing to do? Let's say you earn $100,000 every month, right? Let's say that is your monthly salary. I'm just throwing out numbers. What do you think is best for you to go and save this $100,000, put it in your bank, open FD and put it in the bank, or would it be better to spend it? What are your thoughts as bankers? Like, I'm sure most of you are bankers. So most of you must be dealing with banks. What do you think is best?
Partly spent and partly saved.
Okay, now what happens if you spend the entire thing? Sorry, what happens if you save the entire thing? You don't spend on anything, just the basic needs, and then you save every cent, right? Then what happens? What are the implications of saving every cent, putting everything in the bank? If everyone does it, if every cent,
Deflation, a negative interest rate. Like,
yeah, could be. Yeah, you're quite right. Because if every one of us go and put our money in savings, we don't spend a cent additional, then the economy will not move. Why? Because there is no demand created, no? Just everyone wants to have the basic food, just to travel here and there. That's it. Just the basic needs. No one wants anything beyond that. Right? If no one wants anything beyond the basics, then there are no new jobs that are getting created. Right? Now, for example, if no one wants designer clothing, then all the designer shops will close down. If no one wants perfume, all the perfumery will close down. If no one wants booze, all the liquor shops will close down, which is going to be a disaster, right? Why? Because if these institutions close, lots of job opportunities will get wiped out, right? So if you spend what you earn, lots of the entire economy keeps rolling. Right? It's good for the economy. People will get jobs. They will get disposable income. Also, the government will get tax revenues. When people have disposable income, the quality of life will improve. And when quality of life goes up, people will start spending more and more, which is also good. More jobs getting created. More skills will be required to run an economy, right? So there will be more courses being conducted, right? Then opportunities in the education sector to prepare people for these jobs. It's going to be a growth story. But if people don't spend, it's the opposite. Lots of business entities will have to close down, right? And also quality of life goes up, right? As I explained. So when that happens, there'll be less, well, less in terms of, it's like suppression in the economy. Right? Less people will be, well, people will be actually, it's called, what is this? Less unrest in an economy. There is less unrest, right? People will be happy. Less in terms of crime, probably. Right? People will not steal from others. Yeah, so it's overall good if you start spending. Let's give it some thought. That's actually a virtuous cycle. Can lead to a virtuous cycle. Yeah. Okay. Right. So getting back to foreign exchange, which was our original intention. Foreign exchange market and foreign exchange. Why you need foreign exchange? Right. Well, the foreign exchange market, it's no different to anything else, right? It's no different to a fish market, right? You buy one fish, how much does it cost? The same as a foreign exchange market. You buy one mango, or a fruit market, right? You go and buy a mango. So one mango is 150 rupees. That's the same as $1 is 150 rupees, something like that. Right? That's foreign exchange market and fish market, no difference. Right? So a fruit market is where you go and buy fruits, or a foreign exchange market is where you go and buy or sell foreign exchange. Why do you need foreign exchange? Current account and capital account transactions. Remember what we learned in grade 2. Current account is where you go and start spending on the trade account and all that. Capital accounts is where you go and invest. So if you want to go and invest overseas, then you need foreign exchange. If you want to go and invest in the US or in UK, you can't invest in rupees. You have to invest in dollars. So you have to convert your rupees into dollars, or your rupees into euros or sterling or yen or whatever. Then if you want to import or export, you will get foreign exchange. Right? If you are an exporter and you export to the Middle East, you will be paid in dollars. So if you export to the Eurozone, where GSP plus these days is an issue, then you will receive euros. Right? So likewise, you export to different countries, you will receive various currencies. Then if you want to import, if you want to bring down vehicles, these days, of course, there are strict restrictions on vehicle imports, and most of the imports, you will still need foreign exchange. So that's why you need foreign exchange. So it's around the clock market, meaning it's almost a 24/7 market, but it's not 24/7, it's 24/5, only the 5 working days. Weekends, the foreign exchange market is closed. 4 days and all that, it works. But it's closed in Sri Lanka. The dollar rupee market is closed, but elsewhere in the world, unless the whole world is closed, public holiday for the whole world, the foreign exchange market is active. No central location. Right, so it's not that it's controlled in the US or in London. So there is no central location. It's over the counter, meaning it's like when buying a loaf of bread, nothing different. Right? So there are 2 types of markets. One is over the counter, other one is exchange traded. Now, over the counter means like when buying a loaf of bread. If you want to go and buy a loaf of bread, you don't go to the stock exchange to buy, no. You go to the Kade and buy, right? But if you want to buy shares, then you can't go to Kade and buy. You have to go to a stock exchange. So those are the 2 types of markets, over the counter as well as exchange traded. Over the counter means if you want to buy half a loaf of bread, the Kade guy might give you. If you want to buy 1.5 loaves, he will give you, meaning he will customize or tailor-made. Whereas exchange traded, everything is standardized, right? So if you want to buy John Field shares, you can't go and buy 1.5 shares. You'll have to buy either 1 share or 2 shares, nothing in between. Liquid. Foreign exchange market is liquid, very liquid. So what do you mean by liquidity? What is the definition? How would you define liquidity? What is liquidity to you?
The ability to turn any asset into physical cash.
Very good. Very good. The ability to, now I'll explain using an example. Those of you who are married, sorry, those of you who are single, you guys are liquid. So what happens after you get married? Once you're married, you become? What do you think? After marriage, you become? No one knows? All of you are single? Yeah, after marriage, you become more liquid, right? So you will find out. So that's liquidity. Yeah. In terms of assets, now, let's say you have 100 million of wealth, right? Your wealth is 100 million rupees. And it's the entire wealth is invested in a piece of land, a block of land. You have no other money other than the block of land. That's the only wealth that you have. So it's worth 100 million rupees. You have not a single cent other than that. Right? So what happens if you want to buy a loaf of bread? If all your assets are invested in a loaf of in a piece of land, what happens if you want to buy a loaf of bread? How can you buy a loaf of bread? Very difficult. No, you'll have to sell part of the land, right? So is it easy or difficult to sell land?
Difficult.
Very difficult, right? But in terms of return, if you keep this, hold on to this land for 5 years, right? You stop eating and you hold the land for 5 years, maybe the return will be fantastic. But it's difficult to convert it, a piece of land to convert into a loaf of bread is very difficult, right? Then let's say you have your entire 100 million, you put it under your bed and you sleep on it, right? All in cash currency. And if you want to buy a loaf of bread, it's very easy. You take a note and go and just give it to the kade and buy a loaf of bread. Very easy. So it's very easy to convert the currency into bread, but very difficult to convert land into bread. Okay. So liquidity is all about how easy or difficult it is to convert one asset into another asset. Maybe cash, maybe some other asset. But how easy or difficult is it to convert between assets, one asset to another asset? That is liquidity. Now, in the process of converting one asset to another asset, if you have a lot of transaction cost and all that, that means it's illiquid. But if there is very minimal transaction cost, right, taking a note and buying a loaf of bread, very liquid. Yeah, so likewise, foreign exchange also can have varying degrees of liquidity. Right now, the total foreign exchange market is about $5.3 trillion a day. $5.3 trillion a day. That is the daily transaction volume of foreign exchange. What do you think is the daily volume in Sri Lanka? Daily transaction volume in Sri Lanka? How much?
Between 3 to 5 million.
Yeah, these days, yes, very low. But before the pandemic, during the height of the economic growth, it was about $100 million a day. About $100 million a day, whereas the global transaction volume is about 5.3 trillion. So what is our percentage contribution? Sri Lanka's percentage contribution to the foreign exchange market is about less than 0.01%. less than that, minimal. So it's like a rounding off error, even less than that. No? That is why the Sri Lankan market is so small, and that is why there is so much hope in the Colombo port city. Right? Because if we can get this up a bit, then it will look a lot more attractive to foreign investors. Right? It's been easier to bring them in. Okay. If there are any questions, you all can ask. Eh? By the way, this class finishes at 7:30 or 8. At what time do we finish?
Normally around 4:30 or 5.
I thought about 7:30. No?
Not usually, no.
Pardon?
Usually.
Okay. So unusually you can go up to 7, no? Okay. And what kind of transaction do you think is the major contributor to foreign exchange? Is it trade-backed transactions or speculative transactions? The biggest contributor to foreign exchange is what kind of transaction? Trade. Yeah, trade-backed transactions is about 5% of the total daily volume. Huh? About 5%. 95% is speculative. Okay. So as trade guys, your contribution is only about 5% of the market. So don't get carried away that you all are the kings of foreign exchange. No such thing. Because speculators are the guys who rule the market. 95% of daily transactions, it could be around 99, but at least 95% guaranteed is speculative. Okay. This is how the market is structured. You have the G7 currencies, like the sterling pound, the euro, the dollar, Australian dollars, and the yen. And these are the major centers in the world. So the participants, we all know exporters and importers. Right? You all deal with them day in, day out. Then banks, of course, banks, brokers, investors and speculators, and the central bank. Central bank might intervene in the market. So this is how foreign exchange enters into a country. Right? Because exporters bring in the foreign exchange and importers take out foreign exchange from a country. So in between, lots of things happen. Right? Okay, so you see exporters bringing in foreign currency to a bank, then the foreign exchange is traded amongst banks, and finally importers will take out the foreign exchange from a country. So while banks trade foreign exchange amongst themselves, the central bank will come and intervene, and they might either infuse foreign exchange in the market or absorb foreign exchange from the market. The fundamental terms of foreign exchange. Now, this is like these are basics. Well, you know the difference between trade date and value date, right? Being trade students, yes, obviously. So in dealing terms, there are 4 different days, right? Now, if I if I may explain using an example, let's assume that all of you are single, you are not married, and let's say you see your dream partner, right? Either a girl or a boy. Today, this morning, you spot your dream partner, right? And you want to spend the rest of your life with him or her. So you see her, you get married the same day. And you see her today and you get married on the same day. That is called cash settled. Then you see the person today, you get married tomorrow. That is called Tom. You see the person today and you get married in 2 days, it is called spot. Anything beyond the second day is called forward, right? So the day you see the person is called the trade date, and the day you get married is called the value date. Okay, so there are 4 different value dates: cash, Tom, spot, forward. Anything beyond 2 days is called forward. You have any questions, you can always ask. No questions? Can I continue? Right. Some of the very basics. No, forget about foreign exchange for a minute. Right. Let's not talk foreign exchange. Let's talk mangoes. Yeah. Now let's say you want to buy a mango, right? And you go to a food city or Cargill's, let's say, a supermarket, right? Maybe Cargill's. Now when you go to Cargill's, do you tell the price to Cargill's that you will buy mangoes at 150 rupees a mango? Or will Cargill's tell you the price? What do you think?
Cargills will tell us the price. Price is already quoted.
Sorry?
Price is already quoted the tax
Yeah.
in the price.
Yes, Cargill's will decide on the price. No? You have no say. Right. Cargill's decides on the price. They're called the market maker or the quote. And you are taking Cargill's, the price from Cargill's, you are the market taker. The ask. Okay. So this is how it works. There are always 2 parties to a foreign exchange transaction. One is the market maker, the other one is the market taker. Now let's assume that you go to a bank and you want to buy foreign exchange. Or you want to go to a money changer and you want to buy foreign exchange. You are the market maker or the market taker.
Market
taker.
Market?
taker.
Yes, you're the asker. The market taker. Right. Because you can't tell the bank that you will be buying foreign exchange at this rate. No, the bank gives you the rate and it's either take it or leave it, right? Now, when you do foreign exchange questions, always assume you are the market taker.
So disturbing you nowadays actually the exporters like quotas.
Yeah. Yes. That's actually Porter's 5 forces, isn't it? The bargaining power of customers.
Exactly.
Remember what we learned in grade 2? Can you all remember Porter's 5 forces? Just to digress a bit. Grade 2, what you learned? Forgotten? Bargaining power of customers, bargaining power of suppliers, threat of new entrants, threat of substitutes, existing competition. No? Never learned? That's the thing. So this is bargaining power of your suppliers. The suppliers of foreign exchange are now calling the shots. Oh, sorry, bargaining power of suppliers and bargaining power of customers. Isn't it? Because from one side, the banks that are giving you dollars, right? Maybe the banks that have dollar lines are also increasing rates, right? That's something to do with the country risk and all that. And at the same time, your customers are also demanding. There are less and less exporters coming and converting. And all the banks are fighting for the same set of exporters. So that's what is going on, right? Whereas importers are getting stuck, they are struggling to find dollars, right? I think you may have noticed that Sri Lankan sovereign bonds are going at about 20% plus, right? Beyond 20%. Sovereign bond interest rates are 20% and above. Now, sovereign bonds are denominated in which currency? Sovereign
Dollars.
are denominated in dollars, right? So they are going at 20%, some are going at 30%. Meaning for us to borrow dollars will cost 30%, right? So if you're an exporter and you have dollars outside, then you can perhaps go and invest at 30%, right? Rather than bring in the dollars to the country, you can buy Sri Lankan bonds and invest at 30%. Whereas if you bring the dollars to the country and convert to rupees and invest, then you will get 5-6%, isn't it? So that is the problem that we have to deal with now. Okay, so that's part of the reason as to why central bank had to increase interest rates to make investments in the country at least a little more attractive. Okay, right. Now going back to where we stopped. Any more questions? That was a good question, by the way. Right. So the exchange rate is the value of one unit of currency in terms of another currency. Now forget about dollars. Just put a mango there. Put one. Let's say one mango is 132.50 rupees. One mango is 132.50 rupees. Which currency have we written first? If you say one mango is 150 rupees, you are quoting the price of one mango in terms of rupees, correct? Right? So whatever you write first is called the base currency. Right? That's called the base currency. What you write second is called the counter currency. Now, in the example that I gave, this example, you're quoting the price of one mango in terms of rupees. Right? So mango is the base currency, rupees the counter currency. Clear? But can you also write this as 1 rupee equals how many mangoes? Is that possible? For simplicity, I'll make this 100 rupees. Huh? Yeah, so 1 rupee is how many mangoes? 1 mango is 100 rupees. How much is 1 rupee in terms of 1 divided by 100?
0.0.
Yes. Now, in this example, what is the base currency? What is the base?
LKR.
Yeah, LKR is the base. Okay, so remember whatever you write first is the base currency. Very easy to identify the base currency. Which means instead of writing mangoes, if I put dollars, then Dollar is the base currency in the first example, and rupee is the base currency in the second example. Okay. Wherever I put mangoes, I substitute with dollars. That's it. Any questions up to now? No? Okay, now going back to this example, one mango, 100 rupees. Tomorrow, if you see one mango is 150 rupees, right? This is tomorrow's price, 150 rupees. If this happens, which one has increased in value? The price of a mango has gone up, or the price of the rupee has gone up?
Price of rupees.
Price of
Got rupee got.
rupee gone up.
Sorry.
Price of mango.
Yeah,
Price of mango.
price of a mango is going up, isn't it? Which means if it goes to 200, that means it has gone up even further. But if it comes to say 50 rupees, one mango becomes 50 rupees. Then the price of mango has
Reduced.
it is, yes. Right? Which means if the counter currency keeps increasing, if the counter currency keeps going up, that means the base currency is strengthening. Or the price keeps going up. If the price keeps going up, that means the base currency is strengthening. And if the price keeps going down, that means the base currency is weakening. Yeah. Okay, very easy to identify. Which means if the dollar goes from, say, 100 rupees to 200 rupees, that means which one is strengthening?
Dollar strengthening.
Dollar strengthening. Dollar strengthening means it's
Depreciation.
yes, rupee is weakening. Yeah. Clear up to now? Right, so direct quote. Okay, so what an exchange rate actually means is the price of the base currency in terms of a counter currency. That is called exchange rate. Okay, so it doesn't have to be in currencies, it can be in commodities also. Both comes to the same, the calculations are identical. Okay. Direct quote. Now, when you watch news or when you get the exchange rate sheet from your treasuries, they normally quote $1 in terms of rupees or 1 rupee in terms of dollars. How do you see the exchange rate?
$1 in terms of rupees.
$1 in terms of rupees, right? So now we are Sri Lankans now. So for Sri Lankans, if you give the dollar is the foreign currency, if you give 1 unit of foreign currency in terms of the local currency units, right? So $1 in terms of rupees or 1 sterling in terms of rupees, right? 1 unit of foreign currency in terms of local currency, it is called a direct quote.
Direct quote.
Yeah. So $1 is 200 rupees. This is 1 unit of foreign currency in local currency. It's called a direct quote. But if you say 1 rupee is half a cent, dollars, then you are giving one local currency unit in terms of foreign currency unit, right? So this is called indirect quote.
So can we say that the direct quote is the counter currency in terms of the base currency?
Direct quote is counter currency in terms of base currency. No, it might not make a lot of sense, no? Because you give the base currency in terms of counter currency, no? Right? So $1, 200 rupees. Right? So this is base currency in terms of counter currency. Right? Then if you say 1 rupee is 1 by $200, this is still base currency in terms of counter currency. Isn't it? You got the point. Either way, it is always base currency in terms of counter currency. Whichever way you write. Isn't it?
So
You are
the
right.
keywords to use here are the local currency and foreign currency.
Yeah. You have to look in terms of local and foreign currency. Right?
Okay, so okay, thank you. Thank you.
Yeah. Right. But there are certain currencies, right? Like the sterling, the euro, Australian dollar, New Zealand dollar, and some small currencies which are quoted always as indirect quotes. Meaning, sorry, before I go there, remember the direct quote, indirect quote difference? Right? One unit of foreign currency in terms of local is called direct quote. And 1 unit of local in terms of foreign is called, so this is indirect quote. Direct quote and indirect quote. But in practice, this is not how it happens. In practice, if the dollar is written first, it's called direct quote. If the dollar comes second, it's called indirect quote. That's in practice. Understood? So this is indirect quote because dollar has been written second. Now, the point I want to make is sterling, euro, Aussie, New Zealand by convention are written as indirect quotes always. That means you always get 1 sterling in terms of dollars, 1 euro in terms of dollars, 1 Aussie in terms of dollars, 1 New Zealand in terms of dollars likewise. That's the convention. Understood? Yeah. Any questions? Just now that we did direct and indirect quote, let me also explain what you mean by a cross rate, which is very straightforward. Now here, direct quote is 1 unit of foreign currency in terms of local currency. Indirect is 1 unit of local in terms of foreign. Now what if you have 1 unit of foreign in terms of another unit of foreign? One unit of foreign in terms of another unit of foreign, right? You don't get the rupee here now. Local currency is not given, right? So it is the exchange rate of $1 against Japanese yen, or in this case, $1 against Zimbabwe dollar. These are cross rates because the local currency is not there. You don't get rupees. These are called cross rates. Understood? That's what you mean by a cross rate. That's what you mean when you ask for a cross rate from your treasury. If you want to convert your sterling into US or US into Australian dollars, right? You want to debit a US dollar account and convert it into Aussie dollars, or you want to debit a sterling account and convert to US dollars. You have to use cross rates, right? You don't go through the local currency. Clear? Understood? So the first theory in foreign exchange, purchasing power parity. Right. Now let's take this is also called the Big Mac theory. Yeah? Big Mac, McDonald's. Let us say one Big Mac in Sri Lanka. Let's say it costs you $1,000. Like the price of one Big Mac in Sri Lanka. When you go to the US and if you ask the price of one Big Mac, go to the US and buy one Big Mac, it might cost you $5. Identical Big Mac, same size, same weight, same taste, everything is the same. No difference at all. Right? But the same Big Mac, which costs 1,000 rupees in Sri Lanka, costs $5 in the US. So what purchasing power parity says is using the price of the same commodity in two different markets will reflect the exchange rate. The price of the same commodity in two different markets will reflect the exchange rate. According to that, the US dollar to LKR exchange rate is what? According to purchasing power parity, what would be the US dollar to rupee exchange rate? $200. Agreed? Do you all agree or disagree? Is everyone awake or have you fallen asleep?
Agreed.
This here is called purchasing power parity. Right? But purchasing power parity may not hold all the time. It may not be the case. You might think that it might not apply all the time. It may not apply all the time. For what reasons?
For perfectly inelastic goods.
Okay. Perfect elasticity means there is a
Inelastic.
elastic. Yeah, well, actually, the reason is now in addition to the exchange rate, there are other things now that come into play. Things like taxes, import taxes, transaction cost, then maybe wastage, logistics and all that. And for these reasons. Then there might be additional margins which come into play, profit margins and all that. Right? For these reasons, purchasing power parity doesn't always apply. Clear? Any questions?
Yes, could you explain that again, sir, please?
Which one?
The purchasing power parity, the last portion.
Yeah. You understood the concept? The same product in two different market countries. And the price of the same product in two different countries will reflect the exchange rate between the two countries, right? Okay, so let's say this is not a Big Mac. Let's say it is a mango. One mango in US is 1,000 rupees, and the same mango in Sri Lanka is one mango in Sri Lanka is 1,000 rupees. The same mango in US is $5. It implies the exchange rate will be 200 rupees. That's right. So this can be a car. The Mercedes Benz in Sri Lanka is say 100 million rupees, and in the US it is 5 million rupees. Then also the exchange rate is 100. It can be anything under the sun, but it has to be the identical product, right? In two different countries, the identical product in two different countries will reflect the exchange rate. Clear?
Okay, clear.
Right. But the problem is now, if it's a Big Mac, it might originate in US. So if it's a Mercedes Benz, it might originate in Germany. So you have to bring it down from Germany to Sri Lanka, or from US to Sri Lanka. That will involve freight costs. Now these days, freight costs have gone through the roof, right? Logistics, storage, maybe taxes at customs. For those reasons, the actual exchange rate might be different, right? So maybe in Sri Lanka, it might sell for $1,500. Big Mac. Might actually be 1,500, not 1,000. In which case the exchange rate will get reflected as 300, whereas the actual exchange rate is 200. Yeah. So purchasing power parity may not apply always for these reasons. Understood?
Yes.
Right, so let's just go through this example. A chocolate bar that sells for $150 in Canada should cost $1 in the US when the exchange rate between Canada and dollar is 150, right? So the same chocolate bar in Canada is priced 150, in the US it is priced 1, which means the exchange rate, if purchasing power parity applies, should be $1 is 150 Canadian. Now in this case, if I may ask, which currency is stronger? The US is stronger or Canadian is stronger? Which currency is stronger?
US dollar.
US dollar is, why the dollar is stronger? Why do you say the dollar is stronger? Yeah. Or that's
Because
yeah.
you need more Canadian dollars to buy what you can normally buy with $1.
Very good. Right. To buy the same product, you need only $1, but 1.5 Canadian dollars. Okay. In this example, the US is strong. And if I give you another example, now which one is stronger?
US dollar. US
Which
dollar.
one is stronger? This one?
Canadian
Singapore
dollars.
dollar. Canadian dollar is strong.
Canadian dollars.
Someone said Singapore also. So then,
Canadian dollar.
yeah, 50% chance of success. Either it has to be Singapore dollar or Canadian dollar. 50-50. It can also be, you can also try call a friend. Which currency is stronger?
Canadian dollar.
Canadian is stronger. Why do you say so?
One Singapore dollar price less than one Canadian dollar.
Yeah. Right. Now the easiest, the shortcut is if the exchange rate is more than one. Right. That means the base currency is stronger. Now, if you say one mango is 100 rupees, the mango is stronger, rupee is stronger.
Mango is strong.
Right. For as long as the exchange rate is more than one. If the exchange rate is more than one, the base currency is stronger. Right. So if one toffee is 2 rupees, which is stronger? One toffee, 2 rupees. Toffee is strong.
Top is strong.
Yeah. Yes. Right. So for us now, if the exchange rate is more than one, the base currency is stronger. Now in the Singapore dollar Canadian example, the exchange rate is less than one,
Less than one.
which means the base currency is weaker. If the base currency is weaker, counter currency is stronger. So in this case, Singapore dollar is weaker, Canadian dollar stronger. Understood? Okay, so let's try these examples. Now, before we try the examples, now this one. See, in the first example, the dollar is going from 132.20 to 132, right? So which currency is strengthening and which is weakening? Well, before that, which currency is stronger? Dollar is stronger, rupee is stronger?
Dollar is strong.
Dollar is
Stronger.
Dollar is strong.
Yeah, exchange rate more than one. And which currency has strengthened? What has happened to the dollar?
LK.
Increased or reduced?
Ready.
The dollar has increased in value or reduced in value?
Reducing.
Dropped in value, right? Which means the dollar has dropped in value and the rupee has increased in value. By what percentage? It has reduced by 20 cents. It is a 0.15% drop in the dollar. Clear? Is that clear? How about the second example? Which currency is stronger? Sterling dollar?
GBP.
Pound is
GBP.
strong.
Yeah, sterling stronger. Why?
More than one.
It's
More than one.
So the sterling is stronger. Right, so the sterling has dropped from 152.50 to 152, which means 152 minus 1.5250 started at 1.5250. That's a drop of 0.33%, isn't it? Now the sterling has dropped by 0.33%. Right? Any questions up to now? No questions? Right, so let's try this one, this example. Okay, the first one, exchange rate 132. Right, you have $10 million. How much can you get in rupees? What do you all think?
1000 real, 20 million LP.
Yeah. $1 given as 132 LKR. $10 million equal to 132 into 10 million. Any questions on this? At this exchange rate of $1, 132 rupees, which one is the base currency?
Dollar.
Dollar is the base currency. Which one is stronger?
Dollar is stronger.
Why? Why do you say dollar is stronger?
Rupee rate more than 1.
Yeah,
more than
exchange rate is more than one. That means the base currency is stronger. So the base currency is dollar. Therefore, dollar is stronger. Right. So the next question: if you have 100 million rupees, how much can you get in dollars?
0.76 million dollars.
Yeah, 100 million rupees. 132 rupees is $1. That means 1 rupee is 1 over 132 dollars. Right. 100 million is is this one into 100 million. Okay. Any questions? No questions up now? How about the second one? The exchange rate of euro sterling 0.8585. What is the base currency?
Euro.
Euro.
Euro is the base currency. Which currency is stronger?
GBP.
Sterling pound.
GBP is
Yeah.
GBP is stronger.
Yes.
strong.
Euro is weak, right? Base currency is euro and the euro is weak. The exchange rate is less than 1. If you have 10 million euros, how much can you get in sterling?
8.58 million GBP.
Okay. Yes, 1 euro is 0.8585 sterling. €10 million. Yeah. 8.585 million sterling. We have 10 million sterling. How much can you get in euro?
11.6.
1.6 million.
Okay. 0.8585 sterling is 1 euro. 1 sterling, 1 divided by 0.8585 euro. 10 million sterling. €11.65 million. Any questions up to now? No questions? Right. So let's go back once again to our Cargill's example. Right. Now, Cargill's is the market maker, you are the market taker, correct? So let's say you're going to Cargill's, right? And we'll assume that you have a mango plantation, right? You all have a mango plantation, each of you. So you want to sell your mangoes to Cargill's, right? And we'll assume that Cargill's is giving you the price, you're not giving Cargill's the price. So let's say if you want to sell your mangoes, if Cargill's buys your mangoes at 100 rupees, They're buying mangoes at 100 rupees. At what price will they have to sell if they want to make a profit?
It should be more than 100.
Value higher than 100.
More than 100. So let's assume they are selling at 101. So they buy mangoes at 100 and they sell at 101. What will be their profit?
1 rupee.
1 rupee.
Profit will be 1 rupee, right? So if you are supplying mangoes to Cargills and Cargills is willing to buy mangoes at 100 rupees, they'll be selling at 101 rupees. Now, if you go to buy mangoes from Cargills, they will sell mangoes at what price?
101.
101. Okay, so Cargills is the market maker. They will buy mangoes at 101 and sell at buy mangoes at 100, sell at 101. And their profit is 1 rupee. Okay. So this market maker will have two different prices. They will give two different prices. One is called one is the buying price, other one is the selling price. This buying price is also called bid. Selling price is called
Offer.
bid. And bid means the price at which the market maker is buying which currency, the base currency or the counter currency. In this case, mangoes. No? Mango is the base currency or counter currency.
Base.
Mango is the base currency. Yeah, it's the currency that is written first. No? The price at which market maker is buying the base is called bid. And the price at which the market maker is selling the base is called offer, bid and offer. Okay, and the difference between bid and offer is called the profit. This is the offer minus bid.
It can also be a loss as well, right?
It can never be a loss at any given. Why do you say it can be a loss?
Let's say if they are unable to sell a mango,
Oh yeah,
is it going to perish?
yeah your point is valid. Now let's say at any given point of time, if you go to Cargills now probably they are closed, but let's assume not closed, and you go to Cargills now, right? At this point of time, that means 21st August 2:45, their buying price is 100 rupees, 101. Selling price is 101. They buy at 100, sell at 101. But if you go at 3 o'clock, the price might change. Huh? It might be different, but still, this might be 2:45 and 3 o'clock. Price might change. They might buy at 100 rupees, 25 cents. They might sell at, they might continue to sell at 101. But if they want, they can make it 101.50. Okay, so if you go at 4 o'clock, they might be buying at 99, selling at 99.50. 5 o'clock, they might buy at 95, they're at 95.50. 6 o'clock might buy at 93, might sell at 93.10. So this is 2 o'clock. You understood this concept? At different times, they will be quoting different prices. The price will change based on maybe demand and supply or market conditions. Maybe there might be all of a sudden taxes imposed, things like that. But always they will buy at a lower price and sell at a higher price.
Okay, sir. Thank you.
Clear? The bid will always be lower than the offer. Clear? This might not be, that is because Cargills has the flexibility to change the price, and mangoes are not price controlled, right? But if you are into a market where the price is controlled, something like petroleum or gas, maybe cement, sugar, things like that, the price is controlled. So sometimes in such a situation, you might make losses. You might be buying at maybe 200 rupees, and because of the price control, you might have to sell at 150 rupees. You can't go beyond that, right? So if that is the case, then yes, you might make losses. But if there are no price controls, if it's a free market, always the offer will be higher than bid. Understood? Clear? Any questions up to now? So spread is the difference between offer and the bid, right? It represents the profit. Now exchange rates. How are exchange rates quoted? Right? In the foreign exchange market, what is actually quoted are only these last two digits. Only the last two digits. In this case, euro dollar is given as 1.3275. Okay, so what you see in the market will only be the 75. Meaning, I'll go by mangoes. Again, mangoes. If the price is given as 50, 75, this is the only thing that will be quoted in the market. Okay. If that is the case, it means it is only given the last two digits. So this might mean Cargills is buying mangoes at 96.50 and they're selling at 96.75. Only the last two digits will be quoted. Okay. So these last two digits, in this case 50 and 75, they are called pips. Then the 96 is called the big figure. Okay. In the market, what is always quoted is the pips. Only the pips are quoted. Yeah. Sorry.
Are the pips always in decimal values?
Usually yes. Always in decimals, because foreign exchange rates maximum go up to 4 decimals, right? So in that early example, euro dollar, 132.75. 80. That is how it will be quoted. Right? This means 132.75 bid. Shall I say 85? Bid will be 132.75 and offer will be 132.85. Right? What's quoted are only the last two digits. Only the 75 and 85 will be quoted, right? So big figure will be 1.32 and pips will be 75 and 85, right? So if you go to the market and look, you will only see 75, 85, or you'll see something like this, 132, 75, 85. Now, in this case, euro dollar is quoted as 4 decimals now. So they will quote only the last two digits. That means the third and fourth decimal. But if this is the dollar rupee, you only have two decimals. No? It might be 200. Let's say 50, 80. Let's say 55, 85. Sorry. Means what is a big figure? What would be the big figure?
200.
Yeah, 200 will be the big figure because last two digits are the pips. Always last last two digits will be the pips. Whether it's a 2 decimal rate or a 4 decimal rate, the last two digits will be the pips. Understood? Yeah. Any questions? Anything on top of the last two digits will be the big figure. Okay.
Recently, we can't see any pips in the forex market in Sri Lanka for the dollar rupee. Its spread is more than 5 6 rupees now.
Yeah, that's true. So what happens is now you might get quotes like this 210, and 20, 75, right? If the big figure is not the same, you have to give the both figures, both big figures. Right? If the
Exactly.
big figure is different.
Yes.
If you get a quote like this, 210, 75, 25, then what does it mean? Now what is a bid?
$210.75.
For price.
Offer would be 11.25. Right? It comes to the next. Okay.
How did you get that?
210, 75, 25 now.
Right.
Yes, remember, always the offer should be higher than the bid, right? Offer should always be higher than the bid, otherwise you make a loss, right?
Right.
Yeah.
How it comes 211
Yeah. So offer should be more than the bid now. Now, in this case, if you take 210.75, and if the offer is 210.25, then you make a loss, right? So it has to be 211.25. Unless, but if it's more than 1 rupee difference, then you have to give the full thing like this.
Only if it is 1 rupee difference, we can put like this, no?
Yeah. Only 1 rupee difference. Otherwise,
Okay.
you won't know what the leaf is.
Oh, thank you.
Yeah. Any more questions? So middle rate, right? It's the bid plus offer divided by 2. You might ask your treasury guys what the middle rate is. So what they will do is a very simple calculation. Bid plus offer divided by 2. Okay. Understood?
Yes.
Then if you want to keep a margin, right? I will come to that later. If you want to withdraw $1,000 over the counter, right? From your account, your own account, if you want to withdraw 1,000 rupees over the counter, you have to go to the counter, fill a slip, sign, and give to the cashier, the teller. He will take it to his boss, get it authorized, and then sign a duplicate slip and give you the money. No? You have to produce your identity card and all that, right? In between. So there is a long process, right? But if you want to do a foreign exchange transaction, remember foreign exchange transactions can run into, at a given transaction can be $1 million, maybe more, right? Much more than that, maybe $5 million or $10 million. So to conclude a foreign exchange transaction, this is all it takes. It's like a WhatsApp chat, something similar, right? Just a chat screen. And this example we just run through, they have concluded 5 million Aussie dollar deal at 0.9917. Yeah, I'm reading off the top, 5 million at 0.9917. The currency is Aussie US dollar. Right. So this is how it begins. Okay, this guy in black, the black text, as given as Nalika, calls a bank and asks for a AUD 5 million. What does it mean? AUD 5 million means? It means he's asking for the cross rate for Australian dollar, US dollar. Right. Remember Australian dollar, US dollar? Indirect quote. He asks a quote for a $5 million Australian dollar, US dollar rate. Which currency? 5 million Aussie or 5 million US?
Australian
million
dollars.
US.
No, 5 million Australian dollars. Why? Because remember, Australian dollar is quoted as indirect. Sterling, US, Australian. These currencies quoted as indirect, right? So Aussie dollar is also indirect. That means AUD, US dollar. This is what he's asking for, 5 million. Right. So he wants 5 million, a quote for 5 million Australian dollars. Clear? But if it was US dollar, yen, 1 million? Or 10 million? Then he'll be asking for 10 million US dollars against yen. Right? Okay, so Sven quotes a rate of 1517. What are these 1517? What is 1517?
The pips.
Yeah, he's quoting the pips, right? Now, why market participants quote pips is only because if you're in the market, you need to know what the big figure is, right? You have to know what the big figure is. That's why only the pips are being quoted. So Sven quotes 1517. Now, who is the market maker and the market taker? The two people, Sven and Nalika. Who is the market maker? Who is the market taker?
Sven is the market maker.
Yeah,
Nalika is
Sven.
the market maker.
Yes. Yeah, because Sven is like Kagis, no? He's giving the rate, right? And Nalika is using the rate. Nalika says, I buy. Okay, so if Nalika has gone to Kagis and he's buying mangoes, he'll buy at which rate? The low rate or the high rate?
High rate.
He'll buy at the high rate. So he'll buy at which rate? 15 or 17?
17
17. He has what at 17?
dollars. Australian dollars.
Australian dollar.
Yeah, he has bought Australian dollars, 5 million Australian dollars at 17. Then Sven says, he gives the account instruction for the Nostra accounts. JP Morgan Chase, New York, right? Because see, Nalika has bought Australian dollars. That means Nalika is selling. If he has bought Australian dollars, he is selling. Always two currencies. No? If you buy one currency, you're selling the other one. So what is he selling?
Dollars.
He's selling
US dollars.
US dollars. Selling, right? So Sven will receive US dollars, and he's giving the account instruction. US dollars have to be credited to JP Morgan. Yeah. Right. On 31st January, value date. Right. Nalika says confirms the deal at 99 0. Now he gives the big figure. 0.99 is a big figure. He buys 5 million Australian dollars. Value date 31st, and he's buying Australian dollars. So Australian dollar has to go to his reserve account at Reserve Bank of Australia. All right. Understood? So that's it. This takes less than 30 seconds. To conclude, remember it's a 5 million Australian dollar deal. Okay, it's not peanuts. 5 million Australian dollar deals concluded over a chat, like a WhatsApp chat. Any questions?
For this transaction, the whole number value is 99
Yeah.
7 cents.
Not the whole number, it's called the big figure. Last two digits are only quoted, right? 15, 17 are the pips. So Sven will only quote 15, 17. That means big figure is 0.99. Right?
Okay, so
Yeah.
ex-
The full exchange rate is 0.9917. Now, you all would have, when you have import bills and all that, you probably might ask for value dates from the treasury guys. Yeah. So if you want to convert your dollars into Australian dollars or Japanese yen, you might ask them for value dates. No? Yeah. So this is what happens. Because he has to convert initially the rupees into US dollars, then US dollars into yen, right? So that is when he gets the value date. So that value date only he can give you. Clear? So that's the importance of value date, because foreign exchange transaction, remember, usually gets settled on the spot date. Usually spot date. If you want to settle on any other date, you have to specifically ask. You must say 1 week or 1 month or whatever, or cash, something like that. Okay, clear?
okay, so
Shall we try these questions? First one, dollar rupee 132.50, 134.75. Right, so if you may have noticed, if you just notice, big figures are different. No? 132 and 134, two different big figures. Right? So that's why you have to give the full thing. Now, what is the base currency?
US dollar.
Dollars. Yeah, US dollar is the base currency. It is 132.
50.
50 and offer 134.74. Right? Very straightforward. Let's try the next question. Okay, so dollar yen given at 102.90.95. What rate can you buy dollars?
102.90. Japanese yen.
not 290.
102.90. Yeah, there are two rates. So there is always a good thing about foreign exchange is you always have a 50% chance of success. 50-50. Two rates, 102.90 or 102.95. Right? So it either has to be 102.90 or 102.95. So you can try your luck. 50% of the time you will succeed. What rate can you buy dollars?
0.0097.
Pardon?
102.90.
90. Okay. Right.
102.90.
Okay. These were mangoes. Right. You're the market taker, by the way. Always market taker. If these were mangoes, you go to Cargill's, you buy mangoes at the lower rate or the high rate.
The higher rate.
The high rate. Yeah. So mango is the base currency. Here dollar is the base currency. What rate will you buy the base, right? Meaning you will be buying dollars at 102.95. Isn't it?
Yes, if we are the market takers, yeah.
You're always a market taker. Always a market taker, unless otherwise it is specified that you're the market maker. Always assume you're the market taker. Okay. So what rate will you sell yen?
$102.95.
102.95. Yes, correct. What rate will you sell dollars?
Um,
And then
102.90.
good. Okay. Now foreign exchange. Good thing is there are a few steps. If you follow these steps, you will never make a mistake. Right? So what are the steps? Step 1 is to identify the base currency. Identify the base currency. Step 2, identify what.
you recognize if you're the market taker or market maker.
Yeah, always market taker, right? Always, unless it is specified that you are the market maker. Second one is to identify identify what is being done to the base.
If you're buying or selling.
Yeah, whether you are buying the base or selling the base. Step 3, sell the base at the offer, at the bid, and buy the base at the offer. And always market taker. Four, don't forget steps 1 to 3. Only 4 steps. You stick to these steps, you will never make a mistake. Now, very difficult to make a mistake if you follow these steps. First one, very easy. Now, identify the base currency. What is the first currency? Then figure out what you are going to do with the base currency. Are you going to buy the base? If you are buying the base at the offer, selling the base at the bid. Right? So that's step 2 and 3. Understood? Let's go back to the question. What rate can you buy dollars? What is the base currency? Identify the basis. Base currencies?
Dollars.
Dollar, right? Yeah. So then identify what you're doing to the dollar. You have to buy the dollar. You will buy the base at what? Buy the base at the
The higher price.
yeah, the offer. Right? Remember the steps? Buy the base at the offer. Okay, step 3. Next question. What rate can you sell dollars? Like sell dollars means what are you doing to the base? If you're selling dollars, what are you doing to the base? Sorry, selling yen. Selling yen means base
You're buying
you are buying the base. Buy the base at the
bid
offer.
of
Yeah, 102.95. Then finally, what rate can you sell dollar? Dollar is the base. You will sell the base at the
the bid value.
102.90. Clear? Next one, sterling dollar, 153.25, 153.30. So what is the base?
GBP.
Sterling is the base. First question, what rate can you buy dollars? Buy dollars means what are you doing to the base?
Selling the base.
Selling the base. Sell the base at the?
The bid value.
E-trade.
Yeah, 153.25.
25.
What rate can you buy sterling? Meaning buying the base. Buy the base at the?
Offer value.
So it's 153.30.
30.
What rate can you sell dollars? Sell dollars means base you're
Buying
buying at?
the offer value.
Correct.
153.30. Yeah. Next one, euro dollar, 130.10.15. What is the base?
Euro base.
Euro. What rate can you buy dollars? Buy dollars means euro your base you're
Base.
Selling
selling the base at
That bid.
130.10. What rate can you buy euro?
130.15.
At the offer. Yeah, you buy the base at the offer. What rate can you sell dollars? Sell dollars means base you're
Buying
buying at
130.15.
130.15. Good. The next set of questions. Dollar yen. Give
So,
that.
excuse me, sir. So just one time, just can you explain last one?
Yeah. Euro dollar.
Yes, sir.
Yeah. Okay. So base is euro. No? Okay.
Okay.
You will buy dollars. The first one is you buy dollars.
Sell euro
In euro at
13010. No?
yeah at the bid. Then buy euro at
Buy euro right. All right, 130.
yeah
Just explain what it can you buy euro base base rate we are buying, no?
yes
Base we are buying at 13015.
yeah
At what rate can you sell dollar buy euro same 13015? Fine.
correct.
Thank you. Okay. Thank you.
Next one. Dollar yen 101.50.55. Euro dollar 131.75.80. So dollar yen. What is the base?
Dollar.
Euro dollar. What is the base?
Euro.
Euro.
Yeah. Okay. At what rate? Q is the quoter, A is the asker. What rate the quoter sells dollars on dollar yen? Now you are the market maker. What rate will you sell dollars? Like your cargoes. What rate will you sell dollars on dollar yen? You will sell mangoes at what price?
101.55.
101.55. Your cargoes. What rate will you buy yen? Buy yen means base your
Sell dollars. So
yes. Base you are selling at
101.55.
101. No. Buy yen. You're the quoter, right? You're the market maker. Your cargoes. You're selling the base at 101.55. Then you're the asker, right? You're the customer. What rate will you buy dollars on dollar yen?
101.
155.
101.55.
Yeah.
What rate asker sells dollars on euro dollar? Sells dollars means base your
1.3175.
By euro.
yes. You're selling dollars means what are you doing to the base?
By euro.
Buying euros.
Buy euros at
The
Yeah. By euro higher rate 131780.
131.
80.
Yes, 1.3180. Right.
mm,
131.80. Understood.
Yes.
How about the next one? What rate the asker sells euro and euro dollar? You sell euro and euro dollar?
Ask. Euro. Say
Yeah, yeah. The customer,
75.
yes, 131.75.
75.
Mangoes to Cargills at the bid, 131.75. Then what rate will Cargills buy dollars on euro dollar? Buy dollars means base currency there. Buy dollars means, yeah, they're selling mangoes. Selling mangoes at
131.80.
3180.
180. At what rate will Cargills sell yen on dollar yen? Sell yen means mangoes they are buying. No?
101.50.
150.
150. What rate the asker will sell dollars on dollar rupee?
Huh?
It's a rupee given just to confuse you. It has to be yen, huh?
Yeah.
Because there is no rupee rate in this, no? All cross rates. Huh?
Yeah.
Yeah. What rate the asker sells dollars on dollar yen?
We can't see the screen.
Hmm?
We can't see the screen.
Wow.
Yes.
What rate the asker sells dollars on dollar yen?
Under 1.50.
150. All right. Okay, understood? Everything clear?
Yes.
Right. Now, if you would have noticed your rate sheets, you might have observed 3 different buying rates and 1 selling rate. And most of the banks have it that way. Buying rates, you have buying for currency notes, drafts, and TTs. And usually you have 1 selling rate. So why 3 buying rates? Why don't you have 1 buying rate?
The market is always changing on demand and supply.
Yeah, but at any given time you have 3 buying rates. If 3 customers come at the same time, right?
Yeah.
And one comes with a
OTT
TT,
and
other one
TT.
comes with a draft. Yeah. And the third guy comes with currencies, you will offer them 3 different rates. Why? Because let's say you bought currency notes, right? When you buy currency notes, can you use dollar currency notes within Sri Lanka? Are you allowed to use dollar currency notes within the country?
No, we need to buy them.
Yeah, you can't. You have to exchange it for rupees, right? So usually banks, what they do is, now these days, of course, yes, people will be more willing to accept dollar currency notes than rupee currency notes. But usually you can't use foreign currency notes within the country, right? So what you have to do is you have to convert it into rupees. Now, what banks will do is they will collect currency notes and repatriate, send to maybe Singapore, Dubai, or wherever, right? Because they can't be used within the country, right? So it takes about 2 weeks to collect currency notes, a sizable shipment, and send overseas. Now, when you send it overseas, if you send $1, usually the bank doesn't give you $1; they'll give something less, right? So let me show it on an Excel sheet. Let's say you are repatriating $1. Then the overseas bank will give you only 99.91 US dollars, something like that, right? So this is currency notes. $1 you will get 99.91 US dollars. But today you have to give rupees to the customer today itself. And for you to repatriate, you will take 2 weeks, right? So if you discount it, because you are giving rupees to the customer today, you are going to be out of funds for 2 weeks, which you have to factor in to the exchange rate, right? So what you will do is you will take the exchange rate, let's say 200 into, you're going to be short of rupees for 2 weeks. Let's assume the borrowing cost is 6%. 1 minus 6% divided by 365 into, let's say, 14 days. You have to give him 199.54 maximum. But for every dollar, you are getting only 99.91. Okay. That also has to be factored in. Meaning currency notes buying will be 199.36. Okay. Right, so those are the two factors that have to be considered. You'll be out of funds for 2 weeks, and you will have to charge interest cost from your customer. And also for every dollar that you send, you will not get $1, you get something less. So both of those have to be factored in. Demand draft. Right. Here the customer gives you a draft today. You have to give the rupees to the customer today itself. But the draft will take about 2 weeks to get realized, right? So that interest cost will have to be charged. You'll be short of rupees for 2 weeks. You need to charge from the customer and you give him 199.54. But if he comes with a PT, which is already in your Nostro account, then straight away you can give him a better rate. Right? You have dollars in your account, the customer wants rupees today, so you can give the benefit of there being no holding period. Right? So that's why you have 3 different buying rates. Okay. Any questions up to now? Right. So position. So let's go back to our mango example. Right. Let's say they are all buying and selling mangoes. Right. They're in the business of buying and selling mangoes. Now let's record the number of transactions that we do on a given day. So let's say this is today. Today, if we started our day with 0 mangoes, the price of a mango is 100, our total spent will be 0, no? We haven't bought or sold mangoes, right? Then what will happen to our profits if the price of a mango goes to 1000 rupees? This is the case. If we have no mangoes with us, what is the impact of a price of mango going to 1000? Okay.
Even
We are
for the
missing the
loss.
opportunity loss. We are missing.
No, there is actually no impact. Why? You have no
Even
mangoes.
opportunity.
No, there is no mango. You have no mangoes, right? You still haven't bought. So
True.
whether the price goes up or go down, it's immaterial. Now, if I may use another example, let's just assume that you have no Mercedes-Benz cars with you, right? No Benz cars. So would it matter if the price of a Benz car goes to 100 million or if it comes down to 1 million? If you don't have a car with you,
No.
it doesn't matter. Regardless of what happens to the price, doesn't matter. Okay, but now let's say during the course of the day, you bought 100 mangoes at a price of 100 rupees each. If you buy 100 mangoes, you get the mangoes and you're giving rupees, correct? When you buy mangoes, you have to give your rupees. No? So your rupees will increase or reduce when you buy mangoes.
Rupees is reduced.
Rupees will reduce, right? So let's put it by minus rupee value minus 10,000, correct?
Yeah.
Right. Then you bought another, let's say 200 mangoes at a price of 75. Then what happens? Rupees minus 15,000. If you close the day at this end of the day, you will have a total of 300 mangoes. What's the average cost?
25,000 rupees.
Average cost 83. Isn't it? You'll have 300 mangoes, average cost of 83. Am I right or wrong? Hello.
That's correct.
Okay. Now let's say the closing price of a mango is 100 rupees. or let's say it is 120 rupees. Closing price of a mango is 120 rupees. Right? Then you will make a profit or a loss.
Profit.
Profit.
Profit, why? Because you can sell 300, technically you can sell 300 mangoes at 120 and you will make 36,000 bucks, right? So your profit will be 36,000 minus 25,000. You make a 11,000 rupee profit. But what if the closing price of a mango turns out to be 60 rupees? Closing price of a mango is 60, then you will lose or gain. Yeah. Hello.
Yeah.
Will incur a loss.
Yeah.
7,000
You will
loss.
lose. Yeah. Right. So that means now you have bought mangoes now. Right. Your overall plus on mangoes, 300 mangoes at average cost of 83. So if you have bought and if the price drops, right? If it drops, you will lose. But if you have bought and the price goes up, you will gain. Okay, you buy and the price goes down, you lose. But you buy and the price goes up, you gain. Okay. Now, if you have purchased, then you have surplus mangoes. This is called long, right? Or over bought. Okay, so if you have bought and the price goes up, you gain. Now, for example, if you buy a car, let's say you bought a car for 5 million, then the price goes up to 10 million, you will gain. But if you buy a car for 5 million and the price drops to 2 million, you will lose. Okay, so if you buy and the price goes up, you gain. That means if you go long, the price increases, you will gain. Right? Understood? So far, okay?
Yes, sir.
Right. Yeah, so that is today. Now, next day, let's assume the next day, following day, you are selling 100 mangoes at a price of 80. When you sell mangoes, you receive rupees or you pay rupees.
You pay rupees.
When you sell mangoes,
You receive
You
it.
receive.
You receive.
so your rupees become plus. Okay, so if you close the day like this, you will be left with how many mangoes? You open
200
the
mangoes.
how many?
200 mangoes.
Yeah, you'll be left with 200 mangoes. Rupees? ₹17,000, right? So your average cost is 85. Okay. Again, the same thing applies. If your average cost is 85 and the price of a mango closes at 100 rupees or above 85, you will gain. But if it closes below 85, you will lose. And the next day, what happens if you sell 200 mangoes at 150 rupees? Sell 200 mangoes at 150.
You receive 30,000.
Yeah. Okay. Right. So going back to the example, on the third day you have sold 1,000 mangoes, which you didn't have. Can you do that? You have agreed to sell 1,000 mangoes, but you don't have mangoes, right? At a price of 120. So basically, you can do it. You get a large order and you agree to deliver it, maybe within a couple of days, right? Now, for you to make a profit, you will have to buy mangoes above 120 or less than 120.
Above 120.
You have to pay more than 120 to buy mangoes. So if you pay 150, will you make a profit or a loss? You have sold at 120. For you to make a profit, you will have to buy at less than 120 or more than 120.
Less than 120.
Yeah, if you buy above 120, you will lose. If you buy at 100, yeah, then you will gain. But if you buy 1,000 mangoes at 100, you will gain. You make 20,000 bucks. Okay. In this example, you have sold mangoes without having a single mango with you. So you have sold an asset without owning an asset. Unlike in the previous instance where you had mangoes and you sold. Buying is called long. Selling an asset which you don't have is called short. It's called oversold. Right? Remember, if you buy your long and if you sell an asset which you don't have, if you buy a pencil, if you buy a mango and you sell that mango, that is not short. But if you sell a mango which you don't have, it's called short. Clear? That was understood? Did you all understand that? If you sell an asset which you don't have, it's called going short. Right? So if you all could remember, if you go long and the price fall, you will lose. Right? But if the price goes up, you will gain. Okay, so if you go long, if the price drops, you will lose. But if the price goes up, you will gain. But if you go short, the risk is the price going up or going down.
It's going down.
No, If the price goes down, you will gain. No? See, you sold at 120. If the price goes down to 100, you will gain. Right? But if the price goes to 150, the price goes up to 150, you will lose. Isn't it? Right? So if you are short, your risk is the price. But going up or coming down?
Going up.
Going up is the risk. And you will gain if the price you will gain if the price drops. Yeah. The same thing can be done for currency, applies for currencies also. Right? Now, yeah. Today you are starting with zero now. That's regardless of what happens, you are not impacted, right? That's called squared. Regardless of what happens to the price, there is no impact. There is no risk of price movement. And you won't gain. There is no gain either. Right? No risk, no gain. Yeah. No risk and no gain. Understood? Remember, if you are squared, there is no risk of price changing, of price changes, but there is no gain. If you are long, the risk is price dropping, and you will gain if the price goes up. So if you are short, risk is price going up, and you will gain if the price drops. Is that clear? So these are called positions.
So how can you end up in a squared position?
Right. If you sell all of your mangoes, in this case, if your closing position is zero, whenever your closing position is zero, it becomes squared. Okay, if the base currency amount is zero, you're squared. Understood?
Okay.
Yeah. Okay. So these are called positions. It measures your exposure. Right? The position measures your exposure. Now, on the first day, your exposure is 300 mangoes. Second day, your exposure is 200 mangoes. Third day, you have zero exposure. Fourth day, zero exposure. So that means your position is squared on third and fourth days. Sorry, second and third days. All right. $8 sterling dollar rate is 158.50. 805 sterling dollar, 158.70. So what should you have done at 8 o'clock if you were to make a profit? 8 o'clock, what ideally should you have done? Should you have bought sterling or sold sterling?
Bought sterling.
Get by.
Yeah. Let's say you're talking about 1 million sterling, right? 8 o'clock, it was 158.50. Okay, so if you had bought sterling, dollars, what? You sell or buy? Buy sterling means dollars, you're buying or selling. Hello? If you had bought sterling, what would you do to dollars? You will buy dollars or sell dollars?
You would sell dollars.
You will sell dollars, right? So it will be minus $1.585 million. Is at 8 a.m. Then 805. Right. You will sell the sterling that you bought. At 158.70. When you sell sterling, you will receive dollars. You sell sterling, you receive dollars, 158.70. The sterling position, +1 -1 is 0. But your dollar position,
Square.
no, dollar is not square. It's you're left with $2,000. Sterling, you're squared. Sterling, you'll be squared. Dollars, you'll be left with $2,000. Okay. But by any chance, at 8 o'clock, if you had sold dollars, sold sterling, you had gone short sterling, then you would have ended up with a loss of 2,000 because the exchange rate went up. So you go long and the rate goes up, you will gain. You go short and the rate goes up, you will lose. Clear? Any questions?
So in the previous example, we went short at 8 a.m.
No, long. You had if you went short means you're selling, no?
Okay, so we went long first and then short.
Long first and then you have to square it. When you square it only, you
Right.
end up with the profit.
Okay, so
Clear?
yeah, clear.
So for you to end up with a profit, your base currency should be square. Like you get to 0 mangoes, you have to square your base currency. Okay. So let's try this.
10.36 million.
Okay. Buying 5,155,10. Buy 10,155,60. Buy 5,155,40. Your dollar position will be the average cost 155.43. Is it?
Yes, sir.
Yes.
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 How about this? Australian, right? So regardless of currency, the fundamentals are same. Five million 9340. By 5,093,25. 10,093,25. By 5,093,55. Still 10,093,10. The average cost will be 90.9363. Am I right? And if Aussie closes at 93.89, if it closes at 93.89, to square off, you have to sell 10 million Aussie dollars, 0.9389. You'll be left with 26,500 US dollars profit. Okay. Any questions up to now? Right, so we move on to cross rates. Now, cross rates, as we discussed earlier, is where the local currency doesn't appear. Right, so let's work out these examples. How do you calculate cross rate? Euro dollar, sterling dollar. Euro dollar 133.56. Sterling dollar given as 156.75. You asked to calculate euro sterling. How do you calculate? See, you have been given two exchange rates, which involves the dollar, right? But the cross rate doesn't have the dollar in between. Now, if you remember in grade 5, we have done something like this, no? 2 by 5 equals 2 by 3 times 3 by 5. That's right or wrong, the statement? Okay. My statement is right or wrong? It's correct, eh?
Yes, it's correct.
Right. So you do something similar here. What you do is you take, you have been given exchange rate with dollars, right? So you have to get the dollar in between. Euro divided by US dollar times US dollar divided by GBP. Can I also say that this is equal to 2 by, no, see, the reason I'm going to use it is euro dollar is straightforward, given, no? And then you need dollar sterling, but what is given is sterling dollar, right? So here, I will also say that this is equal to 2 by 3 into 1 divided by 5 by 3. Still the same. This is equal to euro US dollar into 1 over GBP US dollar. So this is actually euro dollar. 133.56 divided by the okay. Do you all get this?
Can you repeat this, sir?
Yeah. Euro sterling. Euro sterling is euro dollar into dollar sterling, no? Right? So dollar sterling I rewrite as the inverse of sterling dollar. Okay. So in this calculation, euro dollar is straightforward. 133.55, 56 divided by sterling dollar. In other words, it's euro dollar divided by sterling dollar. Okay. So the euro sterling rate is equal to euro dollar divided by sterling dollar. Right? So euro dollar 133.56 divided by sterling dollar 156.75. Understood? Is that clear?
Yes.
Okay. The next one is dollar yen 98.90. Dollar rupee 133.60. They want to calculate yen rupee. This would be, again, you put the dollar in between, yen dollar into dollar rupee. Right. So yen dollar is the inverse of dollar yen. Right. So this eventually ends up being dollar rupee divided by dollar yen. It's a dollar rupee on 33.60 divided by 98.90. Is that clear?
Not clear, sir.
Yen rupee, can you write as putting the dollar in between? The same thing, same thing what we learned earlier. Same concept. Only thing here, okay, let me expand it in a different way. This is, you understand the first step, no?
Yen dollar rate into
Dollar rupee, right?
why? How you get that?
You put the dollar in between. Same thing that you did earlier. Put the dollar in between.
Uh,
Same thing.
all right. Okay.
Okay?
Okay.
So 2 times 3 equals 3 times 2, no? Correct? So I will write this the other way around. Okay, so far okay?
Yes.
Okay. Rate 2. Understood?
On the first step, we put the middle USD in the middle. After that, what we have done?
This one, second one.
Yes, yes.
We changed it other way around. You don't have to, just to explain on edit.
All right.
Yeah.
If not,
Hmm?
without doing that, how first step is clear. We are into USD. We put the middle in the USD. After that, why we put USD LKR divided USD JPY?
Same thing, nah? This one. Because 3 by 5 is equal to inverse of 5 by 3.
All right. All right. Okay. Clear.
Right.
Okay.
This is dollar rupee divided by dollar yen. Okay. Then euro dollar 133.56. And dollar rupee 133.60. What is euro rupee? Again, you put dollar in between. This euro dollar into dollar rupee. So this will be 1.3356. This is more straightforward. Euro dollar is there. 1.3356 into dollar rupee 133.60. All right. Yeah. Sure. Hello.
Yeah. Yes.
Yeah. Okay. Right now, that's the fundamental way of doing it. But if you want a shortcut, if you look at euro dollar and sterling dollar, both are what? Indirect or direct? Both are indirect. Right? Then dollar yen is direct. Dollar rupee also direct. Euro dollar indirect. Dollar rupee direct. Remember, direct currency is indirect currency. So the shortcut is if you get two of the same kind, either indirect direct, indirect or direct, then you have to divide the two exchange rates. At the same time, you divide. Then if you get different kinds, you multiply. Same kind divide, different kinds multiply. Now when you divide, which one do you divide? You divide the big one, bigger rate, the larger rate by the smaller rate, or the smaller rate by the larger rate? Out of these currencies, euro and sterling, which one is stronger? Euro is stronger, sterling is stronger?
Sterling is strong.
Stronger. Then if the question asks euro sterling, and if euro is weaker, your exchange rate should be less than 1, correct? That means you have to divide the smaller rate by the larger rate. Okay. So that's why 133.56. Shortcut is you divide the two rates now. Indirect means you divide. When you divide the smaller rate by the bigger rate, right? Because euro is weaker. Now, yen rupee, which one is the stronger currency?
Yen.
Yeah, that means base currency is strong, so the exchange rate has to be more than one. Again, the same kind, no? Direct, no? Same kind means you divide the bigger rate by the smaller rate. You get a 135.09, right? Whereas when you multiply, you can multiply any way you want.
That is much easy to understand.
This one.
Yes, yes.
Yeah. But you have to get it right. Eh? There is a fundamental way as well as a shortcut. Okay. Very easy to remember the shortcut. If it's the same kind, you divide. Different kinds, you multiply. Okay. Okay.
Yes.
Okay. So this slide gives you the shortcut basically. Okay. Right now, what happens if you have two-way quotes? That means if you have bid and offer. Euro dollar 133.5560. And sterling dollar 156.7580. You have to calculate euro sterling. Right. Now, what should you do? You should divide or multiply.
Divide.
Divide. Right. You divide. Euro is weaker than the sterling, so the rate should be less than 1. Which means you have to divide across. Sorry, you have to divide. You have to divide the smaller number by the larger one. Okay. Now you have been given bid and offer. You have to divide the euro rate by the sterling rate. Then remember, when you divide, your bid should be as small as possible, offer should be as large as possible. Okay. So the way to divide is you have to divide across. That means you take 133.55 divided by 156.80. You have to divide across. You have to cut across. To get the offer, you have to do the other side, 133.60 divided by 156.75. That's what you need to do. 133.60 divided by 156.75. Remember, when you divide, you have to divide across so that you get the smallest possible bid and the largest possible offer. Any other combination will give you a larger bid and a small offer. Right? So to maximize your profit, you have to divide across. Clear? Is that clear? Hello?
So we assume the role of the price taker here? When
No,
we,
always you're the price taker.
so we get the smallest bid and the highest offer.
In this case, it doesn't matter whether you're the price taker or the maker because you're just calculating the rate now.
All right, okay.
Calculate the rate and then only see whether you're the price taker or the maker, depending on the question. Okay.
Okay, okay.
Next one is dollar Canadian 98.85.90. Dollar rupee 133.25.30. So both are direct. If both are direct, you divide or multiply.
Divide.
Divide. Again, you divide across. Remember, when you divide, you always divide across. Huh? What am I doing? Canadian is a stronger currency, so your answer should be more than one, right? This will be bid 133. It has to be the rupee rate divided by Canadian dollar rate to get the lowest possible bid, maximum possible offer. That's it.
Okay.
Yeah. Clear? If it's the same kind, direct or indirect, you have to divide. And when you divide, you have to divide across, so that you get the minimum
Best
possible
possible.
bid. Huh?
We get the best possible rate.
Best possible, yes. Minimum possible bid, maximum possible offer.
Okay.
Right? Next one is euro dollar 133.55.60. Dollar rupee 133.25.30. Euro rupee, this is indirect. Dollar rupee is direct. Indirect, direct, you need to
Multiply.
multiply. Okay, so the difference between dividing and multiplying is when you multiply the same side. You don't do across. So that is how you get the minimum possible bid, maximum possible offer. Okay. Understood?
Yeah.
Okay. Shall we try this example? German importer would like to buy sterling in terms of euro. I think it's based in Germany. He wants to buy sterling in terms of euro. At what rate can he buy from the bank if the following market rates prevail? Euro dollar, sterling dollar. So let's try it. Euro dollar 132.20.25. $158.75.80. You need to calculate euro sterling. Both are indirect, so you divide. If euro is the smaller currency, the weaker currency, 132.20 divided by 1.588. So will be 132.25 divided by 1.5875. Right, so it's a German importer and he wants to buy sterling. Buy sterling means base currency he'll be selling, isn't it? Okay. So he'll be selling euro at 83.25. Understood? He'll be selling euro, buying sterling. Clear? Hello? 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 Yeah. So the next example, Sri Lankan tea exporter would like to sell euro. At what rate can he sell if the following rates prevail? Euro dollar 132.20.25. Dollar rupee 132.50.60. Okay. So euro rupee is indirect direct. Means you need to multiply. So it's 132 multiply. You go straight down, not across. He is a exporter, meaning he'll get euros, right? He has to sell, selling the base currency at the bill. Yes.
Yes.
So that previous example, yeah,
Yeah.
you got that euro as a base currency, no? Euro
Yes.
GBP.
Euro-based currency.
How we come to that point? What is the base to take that
Which
without taking GBP to euro?
now you can take that also, but in the question it's given, no, that euro is a base currency.
All right.
Yeah.
The question which
Yeah.
is given.
Yeah. You can do the other way around also. Either way is fine for as long as you get the rate right.
GBP in terms of euro, then that in the question is asking why GBP in terms of euro mean euro is the base currency, no?
Euro is the base currency, yeah.
All right. Okay.
At the end, it's given euro is the base currency. Okay.
Okay, fine.
Next concept is arbitrage. Right? Now, arbitrage means if you buy the same commodity, or can be a currency or anything, right? Maybe a mango. Now, for example, if the price of a mango in Gaul is 10 rupees and in Colombo it is 100 rupees, if you want to make a profit, what you have to do is you can buy mangoes in Gaul and sell them in Colombo. No? So you can keep buying mangoes in Gaul at 10 rupees and sell them in Colombo at 100 rupees. Right? So it is the same commodity priced in two different markets at two different levels. Right? The same mango in Gaul 10 rupees, Colombo 100 rupees. So you can buy from Gaul, sell it in Colombo. Right? You make a straight away, you make a 90 rupee profit without taking any risk. A risk-free profit is called arbitrage. That is using the mispricing of the same commodity or currency or whatever, right? Using the mispricing of the same product in two different markets and making a risk-free profit. Clear? So without taking any risk, you can keep buying from Gaul and sell it in Colombo. That's called arbitrage. But arbitrage opportunities will not prevail for long because everyone will start buying mangoes from Gaul. No? That means the demand for mangoes in Gaul will go up and everyone will start selling mangoes in Colombo. Supply of mangoes in Colombo will also increase. So the price of a mango in Gaul will go up. Supply of mangoes in Colombo will also increase. When the demand goes up in Gaul, the price goes up. Supply goes up in Colombo, the price will drop. And eventually they will converge. Then there will be transaction cost, taxes, logistics, all these costs comes into play. Right? So arbitrage might not last long, but if there is an opportunity, you can make risk-free profits. Understood?
We have seen in local in the Sri Lankan forex market last few weeks.
Yes, very good, very good. So you can buy from one bank and sell to another bank without taking any risk.
Yes, yes.
Yeah. Now, this is also such an example. See whether you can identify any arbitrage in this. It can happen due to market inefficiencies, right? So, now in this case, where will you buy dollars? You'll buy from which bank? When you buy, you prefer to buy at the lowest cost or the highest cost?
Very lowest costs.
Lowest cost. And when you sell, you will prefer to sell at the lowest bid or the highest bid?
Highest bid.
Highest
Highest
bid.
bid. Yeah, so you always should try to buy from the lowest offer and sell at the highest bid. Right? It's like your car, no? When you want to buy a car, you will try to buy at the lowest possible offer. And when you want to sell your car, you will sell at the highest possible bid. Correct? Same thing for currencies. Now, you buy dollars from which bank? What is the lowest possible offer?
HSBC.
Yeah, HSBC. You'll buy dollars at 98.57 from HSBC, and you can sell dollars at 98 to whom?
BNP Paribas.
Yes, you will sell dollars to BNP at 98.58. Can buy dollars at 57, sell at 58, make arbitrage profit. How about this? You will buy euros from?
Bank C,
Yeah, you buy at 29 and you sell?
Bank D.
Yeah. How about this one? You will buy dollars from which bank? You prefer to buy from?
Bank
B.
B.
Bank B.
Buy from B, sell to? If you are selling, you will sell it to?
Bank D.
Yeah. But there is no arbitrage, no, because you are buying from B at 48, selling at 46. So there is no arbitrage. But if you want to buy, you buy from B and you will sell to D, right? Because D is giving the highest bid, B is giving the lowest offer. Clear?
Yeah.
Yes.
Okay, the next concept is on interest rate parity. Have you all heard of forward exchange rates?
Yes.
Yeah. Used for
Yes.
if you book a forward exchange rate, does it mean you have eliminated your risk?
Mitigate.
No.
No, it doesn't mean you have done anything to your exchange risk, right? The exchange risk remains. Why? Because if you are an exporter and if you agreed to sell 1 year forward at 210, and in 1 year, if the market price goes to 500 rupees, right? I'm just throwing out numbers. If the price goes to 500 rupees, you will gain or lose.
Lose.
You lose. But if it goes to 150,
Yeah,
you
gain.
will gain.
Yeah.
Likewise, if you are an importer, you book 1 year forward 210 and the price goes to 500, you will
Gain.
gain. But if the price falls to 150,
Lose.
you will lose, right? So just because you book a forward, it doesn't mean you have eliminated foreign exchange risk. Then what have you done? If you have not eliminated the risk, you have
You can fix the cost.
exactly. That is what you have done. There is no price risk, right? Because whatever happens to the market, you will get the agreed rate, the forward rate, but it doesn't eliminate your risk. Okay, so there is no price risk. That is the only benefit in forward exchange contracts. Yeah. Right. So I was asked to stop with the introduction to forward exchange contracts. Therefore, we'll stop with that. Yeah. Any questions that you may have?
No, sir.
No questions. All right. So thank you very much then. Hope you all understood something and hope it was a useful session. Right. So if that is the case, we will wind up. Thank you. Stay safe and all the very best.